Hi, I'm Nussbaumer from macrobeat.co.uk. The week was really marked by more flip-flop around the US and China trade deal, with news early in the week of starting to hit a snag around the Chinese not being happy about the size of agricultural purchases, as well as demanding rollback of existing tariffs. Then last night we had White House Kudlow actually raising the hopes again that they're getting close for a deal. So it's been the same as it has been all of 2019, but it seems now to almost happen daily where we have the flip-flops. But personally, I start to think we are indeed very close to a deal. I think both sides do need a deal now. We had maybe during 2019, there was always one side that needed it more than the other, but coming towards 2020 or into 2020 election campaign for Trump, I think he needs to show some actual deals, not just talk about it. And we look later at some Chinese data, you will see that the Chinese really need it too. So I think both sides need it urgently. Therefore, I think it's actually going to happen. Other than that, we had the Fed Powell testimony, which usually, in the past has been a very interesting one. This time it wasn't, because he really stuck to what the last Fed meeting did say. We didn't really expect to hear anything new anyway, so the Fed is just out of the frame right now. In terms of charts, I want to look at the first chart, which is the US consumer comfort chart. I know I bring that back from last week. The only reason I really bring it back is that that index has just dropped again from a mid 59 handle down to a 58 handle, and it's needless to say the correlation has worked pretty well overlaid with the equities. And this dislocation now, or this divergence, really starts to worry me, and I'm going to keep a close eye on that. On the next chart, we have the same again, but this is a 3-week change of the same index. And again here, yes, it's a wild kind of index. It flip-flops a lot. But again, the fact is we are at the lows of the 2007, 2008 level. So we just can't deny that there is something wrong out there. Something is not lining up, and we just have to keep an eye on it when it actually suddenly starts to matter for equities. Having mentioned that, on the next chart we have the Chinese data. Reality is that every time we think we have some green shoots, we get disappointed again. The data this week has been rather poor. Actually, all of them have been a disappointment, which is obviously a setback towards all the hopes of the global growth recovery. And hence, maybe a trade deal would at least make us forget that all is not good in the real data, and creates the optimism that maybe with consumer confidence going up once a trade war will be over, that may finally lead to a bottom on global growth, and from there we could actually really start to see some kind of a recovery. But a lot of ifs and buts. First, we have to get that trade deal done, and then we see. On the next slide, and this is now the chart which would go together with slide 1 and 2, obviously. I played around a little bit with it. I injected the Japanese cloud chart, which is something I sometimes look at just to sort of see where we are. Obviously, that cloud level sits around 25,000, which, should we ever see stocks rolling over, that would be the sort of area that would get sticky again. But we're still trading above the speed line of the last 1.5 years. We're north of that 27,500, pushing towards 28,000, and really it's getting more and more scary how high up we currently are. And the trade deal, obviously if we get a trade deal, we actually might extend the top side even further, but then it's really time to maybe start cutting back on equities. On the last slide, we have the dollar index. We talked about that a lot in the last few weeks. 5 days running now, we tried to get above the old 2019 high of 98.37. We struggled to do so. We started to push back again. I think we're probably going to stay in a range. It's probably too early to expect the dollar to fall now that the Fed is on pause, and most of the rate cuts are priced deep into 2020, or actually none around for the early 2020, which makes it maybe hard for the dollar to roll over. But there's just no need for the dollar to put on a fresh rally. So I think we're going to be in this 97, 98.5 range for some time to come. That's me, Nussbaumer, macrobeat.co.uk. Thanks very much indeed. Bye-bye.